Welcome in. You are listening to another episode of the What's Next podcast. Phil, good to see you as always, mate. This question comes up all the time. Should I be on wages or should I be taking drawings? What an exciting topic to rip into.
Jeez, mate, we went back through the archives and this one has been a ripper. So we thought we'd review and update because it's probably in the back catalogue and people just don't want to get into the scroll hole of all of our valuable content. So we thought, let's go again.
Yeah.
It's pretty common. And there's no right or wrong answer for a business owner, whether it's wages versus drawings. And there's just a lot of different variables. And I guess when you're sitting around the bar room, Lena, and that's typically where the convo sums up, it's, oh, Bob, bloody, he takes his drawings, and then bloody Sally over there, she's taking wages. And it's like, well, I'm taking drawings and I don't know whether I'm doing the right thing or not. And you know, am I missing some kind of tax advantage? And I guess that's the thing at the end of the day is what people are looking for is there a tax shortcut or a bit of a tax cheat for taking one over the other? And I guess the simple answer is no.
Yeah, it's good to start with that, that basically there's not there are a lot of differences, but there's not much of a difference when it comes to tax. And I think for 95% of people, they just want to make sure they've paid the right amount of tax, they understand how it works, and then get on back to focusing on their business. But there'll be the 5% that are like, no, I want to know exactly how it works in every sentence. And whenever I hear a client or someone say, what's the best? I just kind of pause and I'm like, oh, here we go again. Because there's never a best. Because the best you only know with hindsight. You know who the best rugby players are, the best people at the Olympics, etc. And it's so easy to say, you know, oh, wages will be best for you. And then in 2 years' time, something's changed. And you then realise with hindsight, oh, actually, it probably could have been better for you to be on drawings.
I think that's it. It's like what's best for you in your current circumstances. Yeah. And circumstances do change. And the ability, and I suppose the beauty of being a business owner is things can flex and we can change.
Yep.
To get into the detail of drawings versus wages, wages I reckon is the easy one. And I would recommend going on wages, and wages would be my preference because there's certainty. You're going to get paid a fixed amount and you're going to receive that every week, fortnight, month, whatever your payroll cycle is. The PAYE is paid and you get the benefits of KiwiSaver. So I'm a big, as we know, listeners to the podcast rave about KiwiSaver. Not only are you contributing 3%, which is a good thing, but your business gets a tax deduction for the 3% employer contribution. That's a good thing. So over the lifetime of contributing to KiwiSaver, you're getting a 3% tax deduction of essentially tax-free income. So
you're putting in your 3% out of your wages, which comes out of your after tax wages as an employee, but then the employer, which is you, contributes to top that up based on the rules. And that is a tax deductible expense, which decreases your profit and therefore the tax you have to pay.
Spot on. Happy days. And 3% might not seem like a lot, but when you're contributing to KiwiSaver, if you're a younger person for 40 years,
big difference. Yeah.
That's going to add up. And there's a lot of younger people getting into business, so why not start contributing and milking those benefits? I mean, everyone's going, oh, you know, what are the tax advantages? Can I milk the system? No, we can't milk the system, you know, because we don't want to get into tax avoidance. But this is one clear benefit for business owners going on to KiwiSaver, and strongly encourage it.
And I think it's often forgotten about with KiwiSaver too, because people don't pay themselves early on in business. And then we're quite big of just planting that seed with clients saying, hey, what are you doing for your retirement? We don't have to give them the answers and we don't have to give them the lecture of what they should or shouldn't be doing, but you can often see a good half of them are kind of like, I'm just focused on my business at the moment.
Yeah.
All good and well, but you know, things can change and you want to be thinking a bit broader than that. Just want to say quickly on KiwiSaver, mate, because I think there'll be some people then going, well, I should just increase my contributions to 10% and then I'll get a 10% deduction from my employer as well. The max is 3% that an employer contributes, right? So you can't just go and try and rip out the profitability of your business by contributing to your own KiwiSaver.
Spot on. You can, but then you'd have more tax to pay.
Yeah.
So keep it simple, stick to the 3%. So broadly, wages are a good thing where you've got certainty of cash flow. And it's probably going to benefit business owners that are established. So you've probably been around for a while. You've got a pipeline of sales. You know what your profitability is. cash is coming in, it's consistent, happy days, pay it. If you're in the early stages of business and you've got variability in cash flow, drawings might be the better option. So that's where you're taking out cash, and the main thing that we've got to remember is that by taking cash out of the business, it's net. It's after-tax cash, because the kicker that people often overlook or forget about with drawings is you're going to have to pay provisional tax, because the difference of drawings over wages is on the profit and loss, there's no expense of wages going through the account. So drawings is not an expense. That comes out of your shareholder current account. Because there's no expense on your profit and loss, your profit is going to be overstated or higher. So at year end, your accountant's going to come along and think they're doing some really cool stuff. Reality is they're not. It's just accounting 101, but they're going to allocate you a shareholder salary based on the profitability. And again, there's no right or wrong answer there. Everybody's situations and circumstances are unique, so you can't go comparing you and Bev and Blim and Bob down the road.
Bob's Beers at the brewery.
That's the one, because they're going to be doing something different, and their profitability is different. It might be a husband and wife team. You might just be on your own. Who knows what the circumstances are? So it's really important that we're not comparing, but it's by taking drawings, the profit needs to be allocated out. And yeah, that's where we start getting a little bit smarter with the tax, that we want to take advantage of the lower marginal tax rates. So income from 0 to, I don't even know what the new tax rates are now.
15,600 is the first.
He's been studying, what, 10.5%?
Yes.
Yeah, and then from there up to 40.
53 and a half, I think.
It was 48 up to 50 something.
Yeah.
Yeah, that's, I don't even know what it is, 30, then from there up to 33. So you get the point, whereas the company tax rate is flat at 28%. So by taking advantage of those lower tax rates, yes, there is a tax saving there. But coming back to the drawings, you're going to be in the provisional tax net. I don't want to get into the detail of like how provisional tax is calculated and all of that stuff, but just by taking drawings, be mindful that you're going to be paying tax in August, January, and May at each installment. And it still blows me away, and it blows you away as well, judging by some of the reactions that I pick up from across the desk, the amount of business owners that still don't have ingrained in them the timing of provisional tax.
Can you remember the dates again?
Yeah. And as like you send the email, July, payments due August. Oh, have I got that to pay? Yeah, I told you about the first installment for this year back in May with the last installment. So you start, but you know.
It's only my second year in business. What do I don't know.
So
you must know those. If you're going to take drawings, you must know provisional tax dates and basically that you're going to have tax to pay, because you're not paying any tax as you go at this stage. So your prov tax is when you pay that tax.
Yep. And a really smart accountant, and I'd probably say those lads at Next Advisory would fit into that camp, would be just eagle-eyed on that tax management piece to make sure you're paying the right amount of tax based on your profitability, so that your prov tax is aligned to ultimately what that shareholder salary allocation would be.
Yeah. Yeah, nice, because that's where it can get confusing for a lot of people, where you might have a company, then your accountant allocates you individually, the shareholder, some of the profit, and it somehow perfectly aligns with the tax bracket, and it keeps you some of your tax under a certain tax bracket, and then the rest of it stays in the company at 28%. All of a sudden, the company's got provisional tax to pay. The individual's got tax to pay as well, and I think that's where it starts to get really confusing for people, because they're saying, well, the company's paying tax, but the company's also paying my tax, and now what do you mean I haven't paid enough tax? I've been paying tax for both, and then it all just gets too hard for them, and that's when I think they go, can I just go on wages to make it simple?
And that's I suppose the other thing is paying provisional tax in 3 installments. It's lumpy, and if you've got some probably average cash flow planning management techniques, and you're not very good at diligently setting cash aside, going on to wages is probably the best course of action for you, because every 3 times a year, you're going to get slammed and reminded, gee, I got to come up with 6 grand, 12 grand, whatever the amount is. And it's just going to be that same painful cycle that you have to go through. And the underlying issue being cash flow management and having good habits to put cash away just aren't there. Wages will solve that for you, because you're taking out the net, the PAYE is paid, done.
Yeah, I thought of a good way. What I've been doing a bit recently, mate, with clients is basically taking them out of their business and saying, let's not look at your business. Let's look at an example of someone else's to get them not just thinking about their stuff. So I think we could do the same with, let's go back to Luke at Foursquare.
Hey.
Right? Where Deirdre and Danny Burke hired me foolishly to do the dollar mixtures.
Yeah.
So she would have income from the sales through the Foursquare, right? And then there would be expenses. The expenses would be food and wages and all those sorts of things. And then you've got your profit and therefore your tax. So that's how business works. Income minus expenses equals profit, pay tax on your profit. Now, when she was paying me a wage, I was an expense. So I would get $300, let's say, but really she'd paid me $500. So she'd kept $200 behind. Some of that went to the IRD and some of that went to clear off my tab of things that I'd run up at the Foursquare, a couple of hot doggies and some hot chips at dinner. But basically, let's say $500 to me, that's $500 in total, my wage, which is an expense on the profit and loss, $300 to me and $200 stays behind and goes off to the IRD. So my tax is getting paid as I go. So I think early on when we get our first job, we learn about wages and it becomes a bit easier because we get it. Now, Deirdre, though, she might have taken drawings. So she might have decided not to put herself on wages. So when she's taking her $300 out each week in the hand, she's still got the tax piece to pay because there's no tax paid. So eventually her accountant would go through and say, right, your profitability, so you had your income, all those sales minus these expenses. Oh, we see you paid Luke some there. Your profit was XYZ. Let's say it was 100,000. We're going to allocate that 100,000 to you as a shareholder salary, which would just be, now at that stage, we just think if she took $100,000 worth of wages throughout the year, then she would have a $0 profit. So then there'd be no further tax to pay. So the accountant's going to say, right, $100,000, you've got tax loosely of $30,000 to pay. You paid $8,000 in August, $8,000 in January, $8,000 in May. That was $24,000, but you should have paid $30,000. You've got another $6,000 to pay. And that is basically as simple as it is and can be explained, I think. And then everyone confuses it with like all this other stuff. What about if you do it for like half the year? And what about a bit of both? And but there's no getting around the amount of tax that you'll eventually have to pay at some stage, whether you're on wages or drawings. Eventually, you will end up with that income in your tax return and be taxed just the same way.
Profit's probably a bit higher for Deirdre because she hasn't done a stock take of the pick and mix where you're going 2 for the bag, 1 for the pocket. And that's why that $6,000's come about.
Not me, mate. I only learned about that after I left. She could be watching.
But you're spot on. And yes, while wages has an immediate tax impact, taking drawings can delay some of the tax impact because the accountant can massage or manage the amount of salary and therefore tax that's allocated. Yep. But ultimately, all you're doing is kicking the can down the road. Yeah. Because if it's not allocated to you as a shareholder salary, there's going to be retained profits left in the company. What have we got to do with retained profits ultimately? Declare a dividend, because you're still going to take the cash out of the business. Because what do business owners do that we know of? Look at the bank balance. I've paid all my bills. What's left? I'll take that.
Yeah.
And if I take that, I'm going to spend it. What am I going to spend it on? A new Ford Ranger.
Yeah.
You know?
And a dividend is an allocation of those retained earnings into the shareholder's tax return. Who's the shareholder? The business owner.
Yeah.
So it ends up in there.
And then there's more tax issues on the dividend, which we won't come to here. Yeah. But when you mention a dividend to a business owner that's either taken wages or drawings and you go, hey, look, and there's more tax to pay, it's just like, oh, I thought I paid it all because I paid my company tax of 28%.
Yeah.
If you've got, and I guess some of the overarching methodology or thinking behind it comes down to your mindset to tax. If you're just so anti-tax and just don't like making payments to IRD, just go on wages.
Yeah, then at least you're clearing it as you go.
Yep.
You're not going to begrudge those big $8,000 and $1,000 payments and then realise like, oh, I should have paid 10, not 8. So now, it's $2,000. What's $2,000? Well, times it by 3, it's $6,000. Go and grab $6,000 out of the account. Oh, I don't have $6,000 there because you've spent some, you've paid some debt down or whatever, and it can add up.
Yeah, for business owners that are on prov tax and don't like paying it, jump on to wages, and even if you start off with something low, just to get started, set up an automatic payment to your bank account, live off of that, try and not take any additional drawings out of the business, and then set up your payment to IRD for the PAYE. Become set and forget.
And ACC as well, right? So you'll be paying your ACC as you go.
Absolutely.
Much like your tax.
Yep.
Yeah. I was speaking to a business owner today, and going back to something you said at the start, mate, where they're not new to business, but they're new to their recent strategy. So basically, to give you a bit more context, let's say business has got off the ground and then they have started to scale up. They're getting some runs on the board, but now every dollar counts. So they did move to wages or could have if they wanted to. So they're paying out the profits as they go, end up at the end of the financial year, and they've basically cleared all of the profits. There's no further taxes to pay. Happy days. That's how they do things. And we've actually got a client who does exactly that, and they then give themselves a PAYE bonus as well throughout the year to clear those profits. And then then there's no worries about drawings and have we paid enough tax. They're basically just clearing the profit as they go. Anyway, this business then acquires assets and things like that. The economy slows down, things start getting a bit tougher, and they want to be able to have the flexibility of that tax piece. So instead of now taking wages, they're back to drawings, and they know that they've got money to put aside for tax, and so they are being diligent, around what's our profitability, and therefore what are we going to be up for at provisional tax installments to ensure that they've paid enough. But they've kind of got their tax money kept back in the business for now as another lever should a customer not pay, for instance, and things like that. So they're at a level of sophistication where they get it, and you talk to them and you can see you've thought about this, you understand this, it's not dangerous. It's the people that you speak to that don't understand it and jump between the two and kind of go, well, Bob, down at the pub, he said this is how it works, so we're going to do this, and you kind of go, whoa, you've got 80% of the picture. And then they end up with this big fright, and it's back into the doom loop of blame, excuse, deny of, what have you guys done wrong? And it's like, why don't you go back to the pub and have a chat to Bob and say you missed telling him this factor, and you also didn't ask him this because you didn't know, so you had a little bit of knowledge and you're dangerous. But someone who does grasp it, you can sort of tell, and then you can let them make some of those decisions. But I think for a lot of SMEs in New Zealand, they probably need guidance to make this decision because they don't truly get it.
The other thing I think that you were talking about before we hit the old record button was when you're applying for debt.
Yeah.
And the banks do like to see payslips. And when you're on drawings, do you get payslips? No, but going on wages, yes, you're going to have a payslip. But being a business owner, the bank will look at that and go, well, is that real? They're going to want to see your accounts. So you've got to make sure that your accounts are up to date anyway. So just because you're paying yourself a wage and you can give yourself a payslip to give to a lender doesn't necessarily mean that they will be able to go, oh, gee, yes, we'll give you that because you've got serviceability because it's come from the business, and if the business is actually making a loss, dudum. Yeah, not ideal.
However, it doesn't mean that just because you take drawings, you can't get borrowing. And I think this pops up a bit for us too, where people say, oh, I need to move to wages. Oh, okay, how come? Oh, because I'm going to be buying a property. I'm going to be borrowing in the bank. They're going to need to see that. Well, if you've got a profitable business, a good mortgage advisor or bank knows how to read those statements and go, oh, okay, there's an $80,000 profit in this business, say. That's the equivalent of an $80,000 salary because they take all of that out and they can see that that money does go into your bank account. So a mortgage advisor will be able to help you through that process.
Spot on.
And it's not just you have to be on wages, otherwise you'll never be able to borrow money. It's a little bit like this bullshit that goes around about, you've got to have a credit card and a gym visa or whatever to get your credit score up. And if you don't, then, you'll never be able to buy a home and you'll never be able to borrow money. Like, do you know what your credit score is? Like, half that stuff doesn't even matter and isn't even applicable. But people see it online from America and think, okay, that's the only way it can be done. Another example, mate, that it just now start getting a bit more technical. So we had a client who allocated some money into their business to get it started, and then it wasn't very profitable, and then they started to become profitable. And so they could see that the money was starting to come in, and to them, they were like, right, well, the money that they introduced to start with is a bit of a sunk cost, like it's gone, they've spent that, put it into assets and different things. Now they're starting to make some money. And so then they go on to PAYE salaries, wages, to start clearing some of that profit. That recognises an expense on their profit and loss. That starts to bring the profit down. And they're thinking, sweet, we're cool here because we don't have any further tax to pay. Now, technically for them, they could still be taking drawings to take back some of the money that they introduced into the business. And in the financial year that they were starting to take wages, they had a profit, but it would have been offset by the losses from the year before. So they kind of thought they were doing the right thing and they wanted to get in the rhythm, but without the conversation to go, oh, you don't have to do this yet. You don't have to go to wages, because you're basically paying tax to the IRD ahead of actually needing to pay it. Because let's say in the 2022 financial year, they had $100,000 worth of losses, and then into 2023, they start making some money. And so then they make $100,000, but they decide, right, we're going to pay ourselves PAYE salaries to clear that $100,000. They do that. They pay tax on $100,000. They've got two $50,000 salaries. That clears it. They've still got a $100,000 loss.
Yeah.
So the $100,000 loss could have offset the loss in the profit in 2023. Now our loss offsets our profit. That's back to zero. They could have drawn out the money that they'd
Put originally.
Introduced, and not paid tax on $100,000. So the IRD now effectively have that tax money and the government to go and spend and fill the potholes in ahead of when they really needed to do it.
Yeah.
And that's where, sometimes it's worth just, when you're going to make a change like this, speaking to your accountant and say, this is why we're going to do this. Can you see anything that I can't see? And not lead with what's the best thing for us?
Totally.
Because without understanding exactly what it is that you're trying to achieve, no one can tell you what the best thing is for you.
Yeah, and something like that would have, on $100,000, like broadly $30,000 in tax, right?
Yeah.
So they've had to stump up with $30,000 in cash.
Yep.
Where they didn't have to.
Yeah, and that could be back in the business.
Kicked the can down the road another 12 months.
Yeah, and been, that's quite rare, but it is something to be mindful of. If you've got losses, and then you start taking wages and you're not using up those losses, then potentially you are paying tax ahead of needing to. I guess the other, the really sophisticated people, sometimes what they'll do too is they'll take drawings, they'll know that they're going to be more profitable, they will pay their obligation at prov tax time, but they will also know, right, well, I'm more profitable, I need to have more money stacked aside, and they will use that and they'll go and invest it. They will go and reinvest it back into the business. They'll do whatever they want with it and figure out how to allocate it, and know that at some stage their tax return will get filed. The IRD will see that they're more profitable and they will have more tax to pay, and at that stage they'll go, right, I've got to go get that money back or turn it into more money and then go and pay that off. So some people play that game as well, but again, you've got to really grasp these concepts and understand how they work, right? Otherwise, that's where we see people fall into trouble.
Yeah, the other thing on wages that's just jumped into my mind is around the salary splitting piece. So where there's a husband and a wife, or it might be the wife's business and the husband's sitting at home doing the washing and the ironing or whatever the chores are, walking the dog. And there could be an ability to split the income so that we're taking advantage of lower tax rates. I guess, yes, that stuff can happen, but talk to your accountant. And I think that's the end theme here is there's a whole heap of variables at play. And just because other people are doing something different and we've got this horrible tendency to compare ourselves to what other people are doing because we've got this fear of missing out on something, particularly when it comes to tax and getting an advantage to reduce paying what we need to. Just talk to your accountant and say, hey, look, this is what I'm thinking about. This is what I've heard. Can you help me understand it? Am I missing out on anything here?
Yeah, we had a client recently who poured a whole heap of money back into their business, and they wanted to know, will we have to pay tax on this when we take it back out? Now, technically, they can take it back out at some stage, but they're still going to have to trade and generate profits and things like that. So when you ask a question like that, you've really got to understand what it is that you're asking and what the answer is that you're getting. Because I could easily say to that client, no, there's no tax on taking that money back out. And they go, great. But I've heard that too many times where I'm like, no, I can't just say that. I have to say, look, but then you're going to put that money into the business that's going to keep you going, but then you're going to become more profitable. You're still going to have tax to pay. So you're still going to have to monitor your tax and pay the tax on that profit. This doesn't mean that you're out of the tax net for a while because you put money into your business. And that's when and that's when you start to flush out, do they really, really understand what they're asking?
Yeah.
I think as well, out of like real back to basics, mate, this is we're talking about for companies mostly. So companies,
Yep.
what a lot of people trade
point.
through in New Zealand. I think
Yep.
over 400,000 companies in New Zealand file a tax return every year.
Yeah, so this stuff doesn't apply to sole traders. Partnership, probably not.
People will probably still call it that because it's just the terminology that gets used.
But yeah, that's a really good point. In most trading companies that are small or medium-sized businesses, these are, it's a common issue. Should I take wages or drawings?
Yeah, yeah. The other thing I reckon that gets tricky, mate, is when you cross between the two. So if you are going to go from drawings to wages, then you're probably going to be jumping from prov tax payments to wages. So speak to your accountant and find out when would be the best time to do this, because you might move to, let's take our client before that clears all of their profit through PAYE salaries and bonuses. Now, they got caught in a cross year where they went from drawings to like, these tax bills are getting too much now. Why don't we just take PAYE salaries? Our cash flow is consistent. We don't mind about paying it each month. Let's roll. They did that, but then they're still getting notifications saying, hey, you've got to pay provisional tax. And they're going, well, why do I have to pay that? It's like, well, the IRD don't know that you're stripping out the profit now through your PAYE salaries. So we have seen where clients have come to us, or prospective clients, and they have moved the drawings. They haven't communicated that with their accountant. They're actually not then making a profit, or nowhere near as big of a profit as they were the year before. And their accountant's just saying, oh, you've got to pay prof tax because the IRD said it's an obligation. Or the business owner logs into my IR, sees it, and so they're like, oh, right, $7,000 off it goes because it says that I've got to pay it. And then you're going, man, we're running out of money. Well, you're paying tax twice because you're paying your prov tax and you're paying it as you go.
And you're ultimately going to get that prov tax refunded.
Yeah, when your accountant does your accounts 9 months after the end of the financial year, and go like, oh, geez, Luke, I didn't realise, mate, you're on wages, so you didn't actually have any profitability. You were paying prov tax you didn't need to be. And in the meantime, you've gone and extended your overdraft. You've made a different financial decision in your personal life because you're like, we just don't have any cash. And all of a sudden, you got 20 grand back. Because you didn't really need to pay it to the IRD. So you've got to understand when you're moving between the two as well.
And I think the other point that highlights is people take for granted that their accountant has got an intimate understanding of everything that is unique about them.
Yeah.
And in our experience, generally speaking, accountants operate mass volume models, and you can't get that level of knowledge of every business owner. So when it comes to prov tax time, it's just like, oh, Bev's got prov tax to pay, poof, fire out the notice.
Yeah.
And actually proactively say to Bev, oh yeah, that's right, we've changed your circumstances. You can ignore that prov tax assessment or payment notice. That stuff can slip through. So as business owners, it's really important that if you've got a notice from IRD, and it's one thing that we've seen they're getting really good at is their comms on text message and emails through My IR to go. And we had a client the other week get in contact. My IR's showing they've got amount of tax that was overdue for payment, and it related to a prior year. And it's just like, mate, let's just cool your jets here a little bit. It's actually all under control. Here's the prov tax stuff that we dealt with months ago. Remember, you don't need to worry about it. We've got it all under control. So if you're not sure, your accountant will give you the answer. Don't be afraid of asking them.
Yeah.
And they'll be able to go. And more often than not, it's blimmin' surprising the amount of times that we've had stories from clients, particularly around prov tax, where they've pushed back to the accountant. The accountant's gone, yeah, no, that's right. Yeah, no, oh, no, actually, you can pay less this installment. Oh, no, you don't need to send that. Sorry, I shouldn't have sent it to you.
How'd you know that? Yeah. Oh, I heard it on the What's Next podcast. Never say that to your accountant again. And I think that raises a good point, mate. If you have a change in your circumstances in your life, in your business, communicate that with your accountant. And we're talking sickness, children, your husband, your wife losing their job, for instance, or not working anymore, buying assets, whether it be in the business, outside the business, taking on debts, because it does create different advice that your accountant will give you. And to give you, two examples of that, we had a client who basically is, for years, it's just been them and one shareholder, one director, and their wife has never been a part of the business. And then about 18 months after, I found out that the wife had actually lost their job and gone away from that, and they decided, well, like, why don't you do some work for the business? And the business could afford to pay that. And once I found it, I'm like, oh, hey, we could probably put them on a PAYE salary. They could be getting paid something. They're like, oh, well, we've always paid ourselves the money out of the business and seen ourselves as a couple, and we just use the net amount that we get after paying our tax. And I'm like, well, if you had told us that, they could have been on wages because they're now working in the business effectively, just like any other employee. But they're like, oh, we just saw ourselves as just saying nothing's really changed for us. I'm like, well, so that's the sort of thing you want to communicate. And then we've got other clients where they might, they don't take wages because they want to hold back their tax and offset their debt in their personal life. And then August comes around, they move that back over into the business, and then they pay their tax, and then they start to build up their tax again, get ready for January, but they're offsetting their mortgage, and then basically whack back into the business, and it gets paid. And so like that's the game that they want to play. But because we know that that's what they want to do, then our advice is different to them rather than just go on wages, for instance. And they've got the sophistication to understand that stuff. So if there's a change in your circumstances in your life, just like you would advise your lawyer about something you need to update your will about, probably a good indication you need to tell your accountant, hey, this has happened. Is there anything that we need to be aware of?
I think if you've made it this far, well done. It's not the most sexiest of topics that we cover off, but I guess in terms of a summary, if you're in this position, if you've got certainty around cash flow, if you don't like paying provisional tax, consider wages. Overall, involve your accountant. They should be part of your business and invested in it just as much as you are, so that they can give you the right advice that suits your circumstances. And then the final piece would be, don't compare yourself to Bev down the road, because her circumstances are different to yours, and her accountant's going to be taking care of what she's up to. I suppose the last bonus one would be, there's no tax secrets here that are being missed by doing wages versus drawings. In the short term, there could be, but overall in the longer term, by taking drawings, you just kick the can down the road and create tax issues for a later date.
Brilliantly summed up, mate. Finally, from me, shout out to all the university students who will be watching in their lectures, because I reckon that professors and lecturers could use this as a bloody detailed analysis of wages versus drawings whilst teaching people accounting.
Yeah, and I reckon the big four franchises could probably pick up this and run it in their grad training.
CPD hours as well.
Absolutely.
5-star review on the way out, please. If you're watching on YouTube, please like and subscribe if you'd like to see more content. There will be more of these videos. Be good, and we'll see you in the next episode of the What's Next podcast.